Hey there, everyone. It's Megan O bringing you another episode of Grow with Megan O. And today we're going to talk about how interest rates affect buyers who are going to refinance the property and buy out the other spouse. So this is related to those who are divorcing and one needs to remain in the property and the other one wants to leave the property. So the one leaving would like to be bought out for their portion of the property, and then the one staying would like to be able to refinance and carry that mortgage with their current income. So how are we going to do that? We're actually going to use a real life case example from one of our certified divorce lending professionals who is in our community, Jason Gordon. So he is a lending professional that specifically works with divorcing parties on getting them qualified to carry the new mortgage on just their income with all the considerations going on in the divorce. And it is rather interesting, tricky, involves a couple different new or different ways of handling the lending process. So it is specialized. All right, so let's use this example. The divorcing party were in the middle of divorcing process and came to Jason in August of 2021. So that's a little bit more than a year ago. And at the time, the property was worth $500,000. The existing mortgage was $300,000. So about an equity gap of $200,000. At that time, the party could qualify at a 2.75% interest rate to refinance the property. However, their divorce was not finalized and there were still other things going on. So, some time went by and they circled back with Jason in March of 2022. At that time, the property's value had increased. It was now $600,000, and the existing mortgage still $300,000, with an updated equity position of $300,000. However, the new loan sought was $450,000, about $50,000 more than the prior loan amount that was sought for a couple of other things going on in the case. And at that time, so we're talking March of 2022, which is just a little while ago, this current year, the interest rate was 4.75%. However, that was 2 points higher than August of 2021 when it was 2.75% interest rate. So at that time, they were ready to refinance, proceed. They ran all of the information with a $450,000 loan amount at 4.75%. With her current debt to income ratio and her income, she no longer qualified. So in just a matter of 6 months, she no longer qualified to refinance, and that increased the increased rate, interest rate did affect her ability to refinance the property. Even though there was still an additional $100,000 worth of equity in that property, she couldn't qualify to carry the mortgage because the rate doubled over just 6 months, as we can see. And then now, as of October 31st, it's hovering just under 7%. So it's increased by more than 3 points. So it is going to be a factor in your refinancing situation. So if you are parties that are looking to structure a deal in your divorce where you're going to refinance one of the parties out, you really need to consider that timeline, what that's going to look like, and you need to structure it in a way that there is a understanding of what's going to happen when that time comes. So if it's a refinance that's 6 months out, 12 months out, 18 months out, 2 years away, what will happen when you get to that point and the potential interest rate is higher and you can't requalify, or there is some other factor or variable in there? If you can account for as many of those variables in your decree, it may be possible that you get there and you don't have hiccups nor have to hire counsel again to remedy those hiccups. Or, of course, the alternative is you sell the property, you take the cash, you live on the cash, and then you go and purchase another property when you're able to, with maybe lower interest rate or higher income or a couple of other different variables. So as you can see, it does affect those divorcing parties. All right, we'll see you guys next month for more great tips on Grow with Megan O. Bye-bye.